Hi guys, my name is Joseph Ejike Oji. I'm here to keep you company today. Um, our topic in this course to, for today will be the financial markets. So let us begin by explaining the meaning um, of a financial market. Yeah. Now, definition: a financial market simply means a marketplace where buyers and sellers participate in the trading of assets. So basically, when I say asset, I mean financial asset, not physical assets. So where that market where buyers and sellers uh, participate in the buying and selling of financial assets, things like equities. When I say equities, I mean shares and stocks, and bonds, currencies, and derivatives. So that market, we call it financial markets. Now we have different types of financial markets. We have primary markets, secondary markets, capital markets, money markets, foreign exchange markets, and commodities markets. Now, before I proceed, I want to explain one thing. Sometimes those markets, there are no physical structure that are built and given the name financial market. No, most time, majority of the time, as a matter of fact. But it is the type of transactions that are done that are given all these names. For example, in the primary market, where the company is listing its shares first time to the public. So we say that it does that in the primary market. It can be any stock exchange. It can be New York, it can be at New York Stock Exchange, or it can be any stock exchange in the world. For that type of transaction, because that is the first time they are doing it. So that market where they came out, they went public, is called the primary market. So that's what I'm trying to explain here. It is these names are given to the type of transactions that were done, not that they are physical market per se, most of the time. Okay. Now let me see. Good. Now let us look at this market one by one. These markets we have. Next one we look at is the first one will be primary market. Primary market, like I explained in a previous slide, simply means the market where new securities are created. So when companies float their shares, make their share available to the general public for the first time, we say that Deca company had made what is called the initial public offer, or IPO. Now, in that case, anybody can now, with the money, can now buy the stock and become one of the owners of the company. So that market, or that transaction of coming up the first time, is what they call the initial public offer, and it is done in the primary market, which can be any stock exchange where the IPO was executed. Okay. For example, I'll give you an example. A company like Facebook used to be a private-owned company, but in 2012, it decided to do its IPO. Now, we call it initial public offer because that's the first time. Because company can sometimes float new shares. They want to raise more money, so it happens. Now, so when Facebook came up in 2012 and floated its shares or did its IPO, it was placed at a value of $38 per share. Now, and the market, the IPO was done in the NASDAQ, which means at that particular point in time, NASDAQ was the primary market. Okay. Now, so let's see. That was how much Facebook was trading when doing its IPO. Let's see how much Facebook is worth today. So to do that, I'm going to take you to websites that we all know, Yahoo Finance, that have a lot of information about this. So I'm going to type in the finance.com, and that will tell us, bring us to where we can find the value of Facebook shares today. So we are there, and the symbol, the trading symbol for Facebook is FB. So I'm going to type FB here. I should bring off Facebook. You can see Facebook Inc. And today the share is worth $312.46. So if you have bought the Facebook shares, let's say you bought 100 Facebook shares in 2012, today it is worth $312.46. So if you multiply that by 100 shares that you bought, I think it was $32 per share, $38 per share. 100 shares that you bought for 3,800, now it is worth 30-something thousand. See, that's why, like I said, I used to tell my students, it's better to do value investing than buying today and selling tomorrow and incurring transaction costs all over the place. Anyway, that's not the point. What I'm trying to make here is that when Facebook came out, the first time, it is called the initial public offer. Let's go back to our lecture notes. Now, the secondary market is the market for old securities. We call them old securities because they're already there for trading. People buy and sell it. So, for example, if I want to become one of the owners of a company like Walmart, all I have to do is to go to the secondary markets or the stock exchange market and buy the shares. There are many ways you can do it. You can go to your bank. They have their brokerage section, the investment shares section, banking section, where you can buy. As a customer, they will help you to buy the shares. Or you can use any of these brokerage firms like Fidelity, Robinhood, and buy the stock and become one of the owners. So you don't have to go to the New York Stock Exchange all the time per se, or in those days when you have to call a stockbroker each time you want to buy shares. Now you can do it by yourself. Anyway, what I'm trying to say here is that in secondary market, the stocks are already there. So they are not new shares. So that's why I said old securities. A good example is the New York Stock Exchange. Then we have the money market, which is the market for short-term securities. When we say short-term securities, what we mean that securities that matures in 1 year or less. So a good example of the securities that we can buy in money market. Like, remember, there is no building that was built and called money market. It is just the type of transaction that is done. If the transaction is if you are buying a security that has a maturity of 1 year or less, so the place you've bought the security becomes your money market, okay? Because that's where you bought the short-term security. So we have things like CDs or certificate of deposit, U.S. Treasury bills. So by U.S., when the U.S. government, federal government want to raise money, they use U.S. Treasury bills. Then we have commercial papers that companies use to raise money. When they need money, extra money, they can use it to raise money, and it matures within 1 year. They pay you back with interest. We also have municipal notes sold by the cities, and so on and so forth. So then they have the capital market, which is the market for long-term securities. When we say long-term, we're talking about 5 years or more. Securities that have matured in 5 years or more, like bond, especially bond. So companies usually go to capital market when they want to raise money. Again, there's no building that is called a capital market. It's the transaction that is done, and where that transaction is done becomes the capital market, because in that market, that place, you bought a long-term security. So good example, like we have a stock market, like the New York Stock Exchange. We have the bond market, the currency and the foreign exchange markets. These are all capital markets, example. Okay. Now, most markets, as you all know, are in major financials are located or concentrated in the major financial centers like New York, London, Singapore, Hong Kong, and so on and so forth. Now, the difference between the financial markets, the capital market, and other financial market is that the capital market is where the businesses go to raise money. Like the bond market, for example. Let's say that a company like Apple want to do a new project, maybe to develop a new phone, and they needed money for research and development, and also for marketing. They can go to the capital market and then sell their bond. When you sell those bonds, and when you buy those bonds, you are lending money to Apple. So the Apple might say that if you buy a 5-year bond, that bond will mature in 5 years. But Apple will be paying you what we call coupon interest or coupon payment every 6 months. It might be 5%, might be 10%, depending. Then every month they pay you the coupon payment until that 5 years. When that 5 years reach matures, they will pay you back your money plus more coupon payment. Okay. So that's the difference. Company could that way. But in the other markets, like other money market or other exchanges, like the primary market and secondary market, you can also raise money from there, but you can also sell shares and buy shares, buy and sell shares as well. Then we have the commodity markets, which simply means the market where traders and investors buy and sell natural resources, things like corn, crude oil. Of course, you know, crude oil, you use crude oil to make gas, gasoline, and petrol, and kerosene. Now, meat and gold. There are other commodities like silver, copper, and so on and so on. So a specific market are created for those kind of commodities because their prices are so unpredictable. Now, good example is the Chicago Mercantile Exchange, which trades on commodities like milk, butter, feeder cattle, pork bellies, lumber, and lean hogs. Now, one thing you have to know is this: in this market, they are not really trading those physical commodities per se. Instead, they are trading future contracts on these commodities. I'll give you an example. If you want to participate in the oil market, trade oil market, you trade two of the largest oil indices, like one we call the Western Texas Intermediate and the Brent crude. So you buy stocks or indexes that track those markets. You're not buying the physical asset per se. Let me show you what I mean by that. I think I'm going to take you to investing.com. Okay. We got investing.com. Now, I will take you down to commodities markets. So you can be in your room and buying those commodities, buying them and selling them without even touching the physical commodities. So this is where we are. I hope you can see this. 1 minute to close this. Let's see. Okay. Now you can see, let's say that this is the commodities. Yep, it's the commodities. So you can click on the commodities, and it says here strong sell. That means that you sell it, don't buy. Now, what are the commodities? You can see the gold, you can see the silver, copper, crude oil, WTI, the one we call Western Texas Intermediate. We want for those crude oil that are drilled in U.S. soil. Then you have the Brent oil and natural gas. So you can buy any of these. Suppose you want to buy crude oil, you can say it's $58.85 per contract. So you can now buy as many contracts of this as you can, And if you are lucky, the price goes up to $60 per, in the contract, then you make profit. So now you buy this, you are trading on oil without even touching the physical oil. That's what they do in most of those commodities market. Okay, but the prices of these commodities depend on the price, vary based on the price of the actual commodities in the physical market. Demand and supply. And I believe you get the point. Let's go back to our work. So, next thing we'll be looking at is the foreign exchange market, which is the largest market in the world. Basically, it is the market where the participants buy, sell, exchange, and speculate in foreign currencies. This market, there's no, like I said, there's no physical place that's for this to say that this is the foreign exchange market. No, it is the transaction itself, which can be done in any place, including banks, commercial companies, central banks, investment management firms, hedge funds, retail forex brokers, and so it can be done anywhere. All these areas are connected using phone and internet. Then you cannot add to that the black market itself. That's the only one I have seen a physical place where you can sell, especially in developing countries, and they are a very big segment of the foreign exchange market. So, like again, the foreign exchange market is considered to be the largest financial market in the world. It is never closes. New York Stock Exchange trading stopped by I think 4 p.m. or 4:30, and many other exchanges. But forex market is open 24 hours a day, 6 days a week. Anyway, you get the point. Now we have then the secondary market, the secondary stock market. The leading one we have are the New York Stock Exchange and NASDAQ. And New York Stock Exchange is a stock exchange that is located in New York City. It is by far the largest stock exchange, when you think of capitalization, market capitalization. And as of 2018, the market capitalization of New York Exchange is $30.1 trillion. I'm sure it is bigger than that now. So you can begin to see what I'm talking about. So New York Stock Exchange is owned by Intercontinental Exchange, which is a private company, a private holding company that is also listed in the New York Stock Exchange. But before that, it was owned by a partnership of New York Stock Exchange Euronext, and also between a New York Stock Exchange itself and then Euronext. There are two partnerships. They merged together. But that was then, not anymore. Now it is owned by Intercontinental Exchange. Okay. Now, the National Association of Security Dealers, which is the NASD, it is what it is called, National Security Association of Security Dealers. So they regulate the license of brokers, those that buy and sell shares, and oversee trading practices. Now, the trading platform they use, that means we call is known as the NASD Automated Quotation System. That's where the name NASDAQ came from. Now, it used to be a quotation system, but now it is actually an exchange of itself. So the NASDAQ lists mainly stocks that are for technology and biotech companies. Technology and biotech stocks, that's the one that are usually listed in the NASDAQ. Now, I wrote here that the NASDAQ is a global electronic marketplace for buying and selling securities, as well as the benchmark index for US technology stocks. So that's another index. Then we can now begin to summarize by looking at the importance of the financial market. So first of all, the financial market provide a place where people can buy and trade stocks, and commodities. So people can go there, company can go there to raise money and invest in projects. Then people can also buy shares and sell shares and make money. So it provide a place where participants like investors and debtors, regardless of the size, we can receive fair and proper treatment. Now, they also provide individual companies and governments with access to capital. When government want to do anything big, that they don't have enough tax revenue to do it, they can go to the stock market and sell bonds. When they do that, they get money and do the project. Then over the years, they pay back the bond, and then life goes on. Private company can also, public company can also do the same thing. And so in the process of raising money fast and doing projects, the companies can increase their operation. When you expand your operation, you need people to run those operations. That means you create jobs. So the financial market actually help, in creating, in dealing with unemployment rate in a country where in a country that have a well-developed financial market. I mean, there's some country that doesn't have a well-developed financial markets, like company like developing countries. For a good example, as big as China is a very big country, but their financial market are not really as well developed. Because of the fact that Chinese invest more of their money in real assets like buildings, properties, or business. So the rate of participation in financial market is very slow compared to well-developed financial market as the US, whereby almost at least everybody that is working full time is actually have a piece of the action through their 401k, IRA, and so on and so forth. Then the stock market indexes. That will be our final topic to discuss before we round up the lecture. So a stock index simply means an index that measures a stock market. It is the barometer we use to measure the performance of the stock markets. So when the indexes are down, that tells us that overall market is down. So the index tracks every slice of the market. For example, we have the Dow Jones Industrial Average, we have the S&P 500, and they have NASDAQ Composite Index. So the index are a subset of the market that help investors to compare current price level with prices to calculate performance of the market in general. Let's look at one of them, two of them. Dow Jones 30 is, we call it Dow Jones Industrial Average, or Dow 30, because it was developed by, it tracks 30 large publicly owned blue chip company. See, blue chip companies. So 30 large blue chip companies. So this word blue chip is a very important concept that, where it came from, it wasn't even related to the stock market. And I'm going to explain. You know that people that play, what they call it, poker, they use chips. Let me show you how the poker chips looks like. They use, excuse me, sorry, let me say, a mistake. Okay, good. Let me use this. Those that play poker use chips. Okay, Pogo. Blue chip. Okay. Now I'm gonna look at the blue chip. It's right here. You see how it looks like. Poker players, see the blue chip that they used to play poker. I'll make it a bigger one this way. See now, no, well, they use chips in general, poker players. So the blue chip represent chips that have more value They use red chip, blue chip, white chips. So the blue chip represent those chips that have a higher value than red chips. So in the game of poker, blue chip have more value than both red and white chips. So we started using that term for companies. Those companies that have more value, we use them to call them blue chips. These days we use the term blue chip to describe companies that have really stayed, past. They are valuable. They have been there for a long time. They have withstood the test of time. Companies like Coca-Cola, Disney, Pepsi-Cola, Walmart, General Electric, Johnson and Johnson, AT&T, McDonald's. So these companies have been have more value, even though their stock, the price of their stock may not be too high, but they have been there for a long time and they're still fighting. They are old dogs, but they can still hunt very, very well. So you notice that I did not mention Amazon or Apple or all those companies. They are those are just new generation. They've not been there for a long time. But this one, the blue chip, have been there for a very long time. They're still there. They're still trading well. So the Dow Jones Industrial Average, I used 30 of them. And they're giving this name Dow Jones because they were developed by Jones. His name is two people. The first one is Charles Dow, and the other one was his partner, which was Edward Jones. So they created this index in 1896, and it's been there for all this time. Next one is S&P 500, which is Standard and Poor 500, and they track the 500 largest U.S. companies that are traded in the stock market. So, and investors consider it to be the best overall measurement of the American stock market performance. Okay, many companies are traded in the S&P. Then we have the NASDAQ, which trade mainly technology and biotech companies. And the kind of company you can see in NASDAQ is Apple, Microsoft, Amazon, Facebook, Tesla, and Alphabet, and so on and so forth. Now let me show you how these indices shows how the market is faring. I'm going to take you to show how the market is doing now by going to Yahoo Finance. Okay, you can see that the markets, see, S&P futures down. See, it's in red, showing that it is down, and there are many of them, many other indices. We have many. Every country have their own. Like we have NASDAQ futures, Russell, and then if we keep going, you see more. This for them. This one are commodities, gold. They are all down. So the market is opening. This is low. Now I'm going to show you where more of the indexes are listed, and then we end the lecture. Okay. So I'm going to take you to investing.com. Investing.com. Okay, take it down. So you can even see if European stock futures lower, caution ahead. See, anyway, you can see all the indices right here. You can click here. You can see S&P 500 is there. We see Dow Jones here, NASDAQ, DAX for different countries, inclusive for European index, and so on and so forth. Now, with this, we'll conclude our lecture. Again, my name is Joseph AGK OG, and I thank you for listening to my lecture. And I hope to see you in my next lecture. Thank you, and have a good day.